Stop what you're doing because this is massive. The Volkswagen Group, one of the most powerful automotive empires in the world, is suddenly flashing red on every single financial dashboard. Its luxury crown jewel, Porsche, has just reported an unbelievable 99% collapse in profits. Now, that's not a correction, it's a nosedive. And it's dragging the entire VW group towards what analysts are now calling its most dangerous moment since the 2008 financial crash. So, just before we take a deep dive on the subject, it's imperative you hit that like button and subscribe so that you get notified the minute we produce another game-changing video that affects your choice of car or SUV. And I promise you'll come to appreciate it. So buckle up and let's plunge straight in. So in today's video, we'll unpack exactly how Volkswagen, once the benchmark for German engineering efficiency, managed to go from a global powerhouse to survival mode in less than a year. And stay tuned because later in this video, I'll reveal how the same electric vehicle strategy that was supposed to save VW is actually threatening to bankrupt it. Now, to grasp the scale, let's start with the hard data. For the first 9 months of 2025, Volkswagen Group generated roughly 240 billion euros in sales revenue. Now, technically, that was an increase of 0.5% over the last year. But if you dig deeper, well, sadly, the illusion fades really fast. Operating profit has cratered to about 5.4 billion euros, and that's a staggering 58% decline. And for the third quarter alone, VW swung to a loss of 1.3 billion euros, compared to a 2.8 billion euro profit in the same period just a year earlier. Now, within those numbers hides the real bombshell, and that's Porsche. Now, Porsche has long been seen as the money printing engine that's funded VW's expansion. Porsche's operating profit has imploded from 4 billion euros to just 40 million euros, and that's almost a total wipeout. And unlike previous downturns, this one isn't about temporary demand, it's about structural collapse. Now, the first major blow came from a wave of one-off charges totaling roughly 4.8 billion euros this year, and it was tied to Porsche's failed EV battery projects, its product realignment, and its asset write-downs. Now, Volkswagen's decision to pivot Porsche's electrification plans midstream has left the brand paying billions to undo years of planning. Entire battery development sites in Europe have been shuttered and supplier contracts terminated at steep penalties. Then came the geopolitical hit. The new US import tariffs imposed in response to Europe's trade imbalances could cost Volkswagen another 5 billion euros this year alone. Now, these tariffs effectively penalize German-made vehicles entering the American market, which has been critical for Porsche's profitability. Even with record deliveries in the US, sadly, the math no longer works. Margins have been totally annihilated, but perhaps the cruelest twist of all is that Volkswagen's electric vehicle success has totally backfired. EV sales happen to be booming across Europe, but every additional electric car sold erodes the company's bottom line. Now, Volkswagen admits that EVs generate dramatically thinner margins, sometimes even losses, compared to the internal combustion models. Now, dealerships earn less commission, the cost of battery materials keeps rising, and the infrastructure investment needed to support these models, it drains cash faster than it comes in. The company itself finds itself totally trapped. Succeed with EVs and lose money, or slow EV production and lose market share. Meanwhile, in China, the group's single biggest market, it's turned into a battlefield. See, Chinese automakers like BYD, NIO, and XPeng They're waging all-out price war, undercutting European luxury brands by literally tens of thousands of dollars while offering comparable technology. Porsche's Chinese sales, well, they've just fallen off a cliff as affluent consumers shift towards homegrown EVs that boast longer range and lower maintenance costs. North American sales are down double digits too, further gutting global profitability. Volkswagen's net cash flow in its automotive division has fallen to 1.8 billion euros, and that is nearly half of what it was just a year ago. Now, the company still sits on about 30 billion euros in liquidity, but remember, Volkswagen Group carries an eye-watering 200 billion euros in total debt when you include its finance arm. Now, think about that. It's an amazing number. It's actually more than the GDP of countries like Greece or Hungary. So with operating margins hovering at just 2 to 3%, well, there's no room for error. One misstep and the balance sheet could totally spiral. And the implications stretch way beyond Germany. Porsche's collapse exposes a broader European weakness. The continent's traditional automakers are struggling to transition profitably into the electric age. They face aggressive Chinese pricing, US protectionist tariffs, and a supply chain still heavily dependent on Asian battery manufacturers. Now, forgive me, VW's experience is a cautionary tale. Scale alone no longer guarantees survival. For Porsche, the crisis is both financial and it's identity driven. The brand tried to chase Tesla while clinging to its luxury heritage, but instead it ended up satisfying neither market. The Taycan, once hailed as a Tesla killer, is now underperforming due to range limitations and production costs that eat into every single sale. So as a result, Porsche's leadership is scaling back electric vehicle targets and they're refocusing on hybrid performance models. Now that's a move that signals retreat rather than innovation. So if you're a consumer, expect fewer incentives and slower model rollouts as Volkswagen tightens its spending. If you're an investor, or realize that this 99% profit collapse isn't an accounting glitch, it's a wake-up call. The entire European auto industry is at an inflection point where cost structure, not brand prestige, will decide who exactly survives. Now, Volkswagen's executives claim that 2026 will mark the recovery year, and that's assuming tariffs ease and supply chains stabilize. But analysts warn that without radical cost cuttings, well, new partnership in battery production and a smarter regional manufacturing strategy, this recovery could easily stretch into the next decade. Now, ultimately, Volkswagen's situation is a brutal reminder that the transition to an electric mobility is not a guaranteed gold rush. It's a knife-edge transformation that can either reward innovators or destroy laggards. So, my friends, if you found this breakdown valuable, smash that like button, hit subscribe, and ring the notification bell so that you never miss another deep dive that reveals what's really happening behind the headlines. And do me a favor, drop a comment below. Do you think Volkswagen can turn this around, or has the German auto empire finally met its match? So thanks for watching, as always, and I'll see you, my fellow car enthusiasts, in the next one. Have a great day.